Welcome to The Explainer. Today, we are going to break down something that sounds, super boring, finance leases, but trust me, it hides this massive story about how companies used to keep billions of dollars of debt completely off their books and how all of that has changed. So, let's say you're running a business, right? And you need a whole new fleet of delivery trucks. You're facing a really big question. Do you just rent them for a while, or is that lease you're about to sign actually, just a clever way of buying them over time? And that right there, that's the heart of lease accounting. It's all about telling the difference between a straightforward rental and what's basically a financed purchase. And as you're about to see, how you answer that question can totally change how the world views a company's financial strength. Okay, so to really get this, let's meet the two main characters in this story. The simple, easygoing operating lease and its much more serious, long-term cousin, the finance lease. It really boils down to this. An operating lease, that's kind of like renting an apartment. You use it, you pay your rent, and when the lease is up, you walk away. A finance lease, though, feels a whole lot more like taking out a mortgage. It's a serious, long-term commitment that looks and feels a lot like you own the thing. So with an operating lease, you get this amazing flexibility. It's perfect for stuff you might want to upgrade all the time, like computers or company cars, because you're not locked into owning them forever. But what's the catch? Well, you're really just paying for access. You never build any equity. Now, a finance lease, that's a different animal. It gives you all the perks of ownership without having to drop a huge pile of cash up front. It's great for those big, essential assets you'll need for years. The trade-off, though, is more responsibility. You're on the hook for all the maintenance, and you are locked in for the long haul. Okay, so this is the big question, right? How do accountants officially draw the line? They can't just go with a gut feeling. To stop companies from playing games and hiding debt, they came up with a very specific, very clear test. The whole idea behind official test is pretty simple. It asks, does this lease transfer pretty much all the risks and rewards of owning the asset to the person leasing it, what we call the lessee? If the answer is yes, then accountants have to treat it like a purchase made with a loan. So to make it official, there's this 5-point checklist. Think of them as tripwires. They look for clues that this is more than just a simple rental. Like, do you get to keep it at the end? Does the lease last for, say, more than 75% of its useful life? Do the payments cover almost all of what the thing is actually worth? And here's the kicker. This is the part you really gotta get. You don't need a yes to all 5 questions. If the lease agreement triggers just one of these conditions, that's it. Game over. It must be classified as a finance lease. And believe me, this isn't just some boring accounting detail. This classification has a huge impact on a company's financial statements. Let's take a look at how it completely changes the balance sheet and messes with all the key numbers that investors are looking at. So with a finance lease, a company can't just hide it in the footnotes anymore. They have to put 2 new things on their main financial statement. First, an asset for their right to use the item, and then, balancing it out on the other side, a liability, which is basically the debt they now owe. This little table shows it perfectly. Look at this. The second the lease is signed, boom, the company's assets go up and its liabilities go up by the exact same amount. This immediately makes the company look like it has more debt because its whole financial structure has changed. And it doesn't stop at the balance sheet, oh no. The impact flows right through to the income statement too. An operating lease is simple, right? Just one line for rent expense. But a finance lease gets split into 2 parts. Depreciation for using the asset, and interest expense for the liability, just like a loan. Okay, so just when you think you've got it, there's one more little wrinkle. How a company actually does this accounting depends on where they're based. The world's 2 main accounting rulebooks, IFRS for most of the world and US GAAP for the States, tackle this a little differently. So here's the deal. Under the international IFRS rules, that old distinction is pretty much gone for the company leasing the asset. Almost all leases have to go on the balance sheet now. But in the US, under what's called GAAP, they still keep those 2 categories around, which mainly just changes how the expense shows up on the income statement. All right, we've gone through the what and the how, but now for the most important part, the so what. Why does any of this really matter to an investor, an analyst, or, well, anyone trying to figure out if a company is healthy? This quote from Wikipedia, it just nails it. For decades, companies could use these operating leases to make themselves look way healthier and less risky than they actually were. These were real long-term debts that were basically invisible, hidden away in the footnotes of the reports. The new accounting standards were all about dragging this hidden debt out into the light. And this chart shows you the effect. A company's debt on paper could just explode overnight once these rules kicked in, giving everyone a much more honest picture of what was really going on. And that right there is why you should care. This wasn't just a rule change for accountants, it was for investors. It means we can finally compare apples to apples, especially for airlines or retailers that lease everything. We can finally understand the true size of their financial commitments. So the next time you're looking at a company's financials, you can ask a much smarter question. Am I really seeing all of its debt? Thanks to these rules, we have a much better shot at knowing that a simple rental isn't some huge liability hiding in plain sight. And that gives all of us a clearer, more honest view of a company's real financial health.